Hello guys, how's it going? In this video, we will be trying our level best to demystify the hedge fund space. You must have heard from people online that when they speak about hedge funds, they say, oh, hedge funds don't do this, hedge funds have this type of risk management style, hedge funds invest in this type of strategies, things of that nature. But the truth is, speaking about hedge funds is like speaking about a type of racing car, right? It's a specific type of vehicle, but when you say racing cars are made of this, they have this type of engine, a certain type of suspension, certain structure, then the question is, well, if there's an experienced racer, he would ask you, well, what type of racing are you talking about? Are you talking about F1, NASCAR? Are you talking about a rally type of racing car? Or those rallies that happen in the desert are made, the cars are made differently, the suspensions are different, the tires are different, the engine is also quite different. So a shallow knowledge of the fund space will make you think that hedge funds all have the one type of schema that they follow, but that is not the case. I have done my research and found out that actually there's different types of hedge funds, and today I will try and demystify that for you guys and try and simplify it, and just show you what different types, according to me, the different types of hedge funds that are out there in the market today. So over here you see the title hedge funds, the type. So we're going to start off with type 1. Start off the first type. I've just made classifications based off of my understanding and try to make sense of the complicated world of hedge funds. So the first column here, you see the first row is function, and then we're going to speak about the functionality, how the types are categorized based on the functionality, and then the second thing is the need. What is the need in the market? Is the need low, medium, or high? So let's start off with type 1. The first type of hedge fund is those funds that hedge risk against the market. Markets against markets, like, so we could say against the market, example, the S&P 500, the Dow, and the FTSE, etc. Okay, and these type of hedge funds, their function, when they give you their offering, they say that they are trying to hedge against the market risk. Okay, the market risk. Like the S&P 500, so right now the S&P 500, if it starts to come down, if it does a retracement, say 40-50% retracement, or comes down 40-50%, then these type of hedge funds will hedge against that sort of risk. So they are supposed to be uncorrelated to the market, and they are not concerned about how much returns they get you, but the most important part is to hedge against the risk in the market. I'm just going to close the door. Okay, so their function is to hedge risk against the market. And what are the returns like? So they can get you anywhere from -5 to 5% per year. Okay, so the returns, ROI. So the ROI is -5 to 5% per year. They're not really concerned about generating alpha, because their function, as I mentioned, is to hedge against the market, hedge risk against the market. What's the need in the market? So how necessary are these companies? Well, you see, the thing is, There's intelligent investors, and there's investors that aren't intelligent. The politically correct way of saying that. So a lot of people acquire money, and they haven't really done it through a sophisticated method, and so they haven't really developed their intellectual understanding anyway of the financial market is quite low. So for those types of people that are also consumed by other things, they have their multi-million dollar, multi-billion dollar businesses, they can't be bothered thinking about their investment strategies. So for those types of people that have invested a substantial amount of money in the indices or in the market like S&P 500, Dow, and indices like that, they have invested in those markets, then for them it makes sense to invest in these types of hedge funds to hedge against the risk. So I would say the need is medium level of risk, medium need, because the reason is if you have a multi-billion dollar company, you can get portfolio managers to manage your fund. Then those guys, to hedge against risk, would basically buy options, right? You can buy put options, right? Buy buy options, put. You can buy put options against the market to hedge against market movements, and you can buy inverse ETFs. So the need becomes medium, not high, because you can easily mitigate against market risk by having a balanced portfolio. So by having a diversified, balanced portfolio, not putting all your eggs in one basket, you can easily mitigate against market risk, as much as these guys would be able to do. So if you were able to get a financial advisor or financial manager, instead of getting a hedge fund, which it charges about, these guys would charge you about anywhere from, say, one. So what's the fees? Okay, so I need to find a place to write the fees for these guys. Okay, let's just do this. And the fee. Let's create another column, another row for fees. And these guys will charge you anywhere from 1% management to 1% management fee, and say I think they'll charge 15% performance fees. Okay, so they'll charge you 1%. So if you invest $100 million with them, they'll charge you $1 million for the management fee for the year per annum, and 15% of profit over a certain threshold. And so these fees you could easily mitigate by hiring a guy that you would pay $250,000-$300,000 per annum. You could get a portfolio manager that could manage your portfolio and could easily hedge against the market by buying put options and inverse ETFs and balancing the portfolio. To balance a portfolio, you just need a guy with a credit in commerce, in finance, that can easily balance portfolio, and it's not really that difficult to have a bullet. 60-20-20 is one of the rules that fund managers follow. Okay, so what's the next type? Type 2. It's not diabetes because there's more types. So type 2. What's the function of the type 2 type of hedge fund? Which one should I go with next? The next one is I would say the next one I would describe hedge funds. They do not really hedge. They would aim to generate returns with low risk VAR, right? Low VAR. So low risk. That is their aim, to take low risk and generate returns. But not generate returns, but to beat the S&P. Their job is to generate alpha. The job is to generate alpha with low risk. And how much are they actually able to do? So anything over 10% and up per annum, right? Annualized return of 10% or above, you're able to beat the S&P returns. That would be considered as alpha. These guys are generally able to return anywhere from -7 to 8-9%, maybe about 8 to 9% ROI. That's per year, right? So their job is to generate over 10% returns, but they are most of these, over 90% of these people, because they take low risk, it's like taking low risk is like putting a limiter on an engine and asking it to go fast. That's why these guys aren't able to generate alpha, so they're basically wasting your money with these guys. And so in the next video, we'll talk about why people do this. Why would people go with step 2? But for this video, not to make it too long, I'll just tell you what they actually are. And their fees are around 2%. Oh, actually, these guys go low. So these guys can go from 0.5 to say 1% management fee, and they go about like maybe 10 to 15% performance fees, right? So 0.5 to 1% management fee and 10 to 15%. Again, there being a threshold on performance after which they can start to generate performance fee. It's called a hurdle rate. And they aim to generate alpha with low risk. Most of them are unsuccessful, so they go anywhere from -7 to 8 to 9%. And the need in the market is actually again low. The need is high actually. The need to beat the S&P 500 is actually quite high. How are you able to mitigate this risk? As Warren Buffett says, Warren Buffett talks of these guys, the type 2, as basically useless, and it's better to just invest in indices. Right? Indices like the S&P 500, like the S&P, like S&P 500, etc. The Dow, the DAX, etc., etc. It's better to invest in them than getting 8 to 9% ROI, and then getting on top of that you're underperforming the market, and also you having to then pay fees of 0.5 to 1% and then 10 to 15 on the performance itself. So it kind of really doesn't work for you, And I'm just gonna pause for a moment. Okay, let's go with type 3 now. Type 3 are the actual performance, the guys that actually generate alpha. So these guys, again, they are tasked with, their function is to generate alpha with medium to high risk. Right? Their task is to generate alpha with medium to high risk, type 3. So they understand that in order to get the returns that we are after, to generate high alpha, you need to take more risk. And these are mostly the only guys that are able to generate good alpha in the hedge fund space. And they charge similar fees. So the highest fees are charged by these guys. They charge 2% management fee plus maybe 20 to 30% performance fees. And these guys consist of about less than 1% of the hedge fund space. So whenever you think about hedge funds, they're highly educated, lots of experience, function at the highest level. You'd think all the hedge funds are beating the S&P. It's only the retail people that aren't able to. But the reality is more than 90%, 95%, even 99%, dare I say, of hedge funds are not able to generate consistent alpha. So these guys, or decent alpha, that can be something that would be considered noteworthy. And so they charged, because they're able to generate alpha, they charge 2% management fee. It can go up to 4% as well. And they 20 to 30%, and some have known to even charge 40% in management fees, in performance fees, because they're able to generate alpha. These guys are actually the heroes, the legends of the hedge fund space. This is what everyone aims for, but most of these professionals like us aren't able to achieve. Well, I am able to, but that's why I'm teaching you, because I'll show you how the hedge fund space is set up, and what the people that actually understand how to generate alpha are those that are able to, and those that put limiters on themselves are not able to consistently generate alpha. What's the need in the space? Need is high. Just like we spoke about type 2, type 3 is basically doing the same thing, but the methodology is different. So the need is quite high. And how would you mitigate? Are you able to do anything to not go ahead with type 3? I would say no. There's nothing you can do, right? A normal person would not be able to generate the type of consistent returns that a high-performing hedge fund would be able to. So these guys are the ones that we actually want to invest in. That would be the ideal if you want to generate high alpha. And then we have finally type 4. Type 4's function is the same as this: generate alpha with low to medium risk. And these guys so I didn't speak about how much these guys are able to generate here. They are able to generate anywhere from 15 to 30% ROI. These guys are able to consistently generate between 15 to 30% ROI per year, and that's why they're able to charge the fees, and that's why it's very clear who you should be going with. But identification of these guys it's where the trick is. And so these guys also claim to generate alpha type 4, but with low to medium risk. These guys are going with medium to high risk, right? These guys are going with low to medium risk, and that's where the problem arises. But the thing is, they're able to generate it 15 to 30% ROI per year. They're able to generate that return. So why are they different to these guys? I'll tell you. and they charge 2% management fee plus 20% performance fees. The need, what's the need in the market? Again, high. But what are these guys? It looks like exactly the same as that, only they're taking medium to high risk, and these guys are taking low to medium risk. Now, if I just showed you these two types and I said choose one of these, right? You were educated at a good college, you have a good job, you're a doctor, you're a lawyer, and then you've been able to create a business for yourself through these. You have a law firm, you have a medical practice that you're generating millions of dollars, and then someone said, hey bro, I'm a fund manager, right? I don't have an Ivy League degree, but I've got a system that generates 15 to 30%. I understand how to generate alpha, and I'll be charging you these fees, 2 and 20%. And you would say, yeah, I've got $1 million that I'm happy to risk in a hedge fund. So and then the other guy comes in. He has a good job. I mean, a good education. He is Ivy League, studied at one of the top universities, and he's worked for like a top fund, and then he's opened his own hedge fund. So you have someone like me and someone like this guy, and he says, look, I can generate with low to medium risk, similar as this guy Javed is offering, 2 and 20%, same as him, but your risk is going to be low to medium. Who would you invest in? Right? Naturally, you would invest in this guy. You have an affinity, or he's educated, right? So you'd invest in this guy, but he's generating 15 to 30% returns. And this guy is looking at that guy and saying, look, if you're going to take low to medium risk, you should be, remember that you should be like type 2. Type 2s are the guys that aren't able to generate alpha. So how are these guys able to generate alpha? It's very questionable. They're not taking medium to high risk. And so what you end up realizing after a few years is that these guys are scammers. They are literally scammers. Example, I'll give you an example. Couple examples. There's heaps of examples, but two main top ones that you would, if you're in the hedge fund space, you would know about. Bernie Madoff, and the other example is Sam Bankman-Fried. I don't know how to spell his last name, but I'm thinking something like Sam Bankman-Fried of FTX. Remember FTX, the biggest, one of the biggest crypto scandal done by Sam Bankman-Fried and Bernie Madoff. Who invested in these guys? That's the question. Did retailers invest? No. Most of the investment was done by professionals, people who were in the fund space, people who were highly educated, people who had a lot of money, who were investors as well, professionals that invested in these guys because they promised you returns, they showed you returns with low to medium risk, which is bloody amazing. Hardly anyone is, even the best of the best aren't able to generate these types of returns by taking low to medium risk. So you're thinking, wow, I'm just going to invest in this guy. Found out that there were scammers. They were moving money from different accounts and paying returns using the basically doing scammy type of stuff. I could go in detail, but I'm thinking about my audience. I don't want to confound you guys. But everyone that knows that Bernie Madoff and Sam Bankman-Fried had similar models where they were scamming people and pretending to generate alpha when they were actually embezzling money from one account to another. So it was a scam. So type 4 are the scammers. Scammers aren't only in the retail space that sell you their courses that don't really work or based around vestigial systems, but it's actually in the fund space as well. And these are the top examples, but there are many scammers in the space, and most people get hooked in by their backgrounds, which it's a simple way of looking at the fund space. So these are the four main types of hedge funds according to me. And if you have any questions, put it down in the comment section and I will respond to it. So just reiterate, the four type are the scammers. The third is the actual legit high performance, right? Performance. This is the one that is like the objective of all fund managers is to be this type of fund. Okay. And the first one was those that hedge against market risk, and we've spoken about that. The second was they try to generate alpha, but they are unsuccessful. They aren't able to consistently generate alpha. So there you go, guys. A little bit of demystification. I know there's a lot more to talk about. A lot of different types of questions arise in your mind, but we'll take it one step at a time. How do you eat an elephant? One bite at a time. Thank you very much for watching.